Welcome back, investors, to Ticker Time News. I'm Adam. Thank you for joining me for the After Hours show. Boy, do we have a lot to talk about today, like we do every day. But the most important thing is what's on your mind. If you have a question, leave the ticker symbol and your question in the comments, and we will go over it live during the show. I hope everyone has had a great day, a great first week to the year. And yeah, let's just get right into it. Today's Friday, so I don't want to keep you too long. But with stocks selling off one day and gaining the next in a convictionist rally, the growth and value divide is widening. Most investors in the market are dumping growth stocks to go to value stocks. So, wouldn't it be great to know what the top 10 stocks are in categories like value, growth, dividend, and momentum? Well, great news, my friends. We just uploaded our top 10 stocks list for each of those four categories. That's over 40 high quality stocks ready to choose from that are constantly updated. So you always have the best names available. Click the first link in the description or click the link in the live chat to become a member and get instant access to the top 10 value, top 10 growth, top 10 dividend, and top 10 momentum stocks, and so much more. We've done the research so you don't have to. Now, stocks traded mixed today as investors digested the latest payrolls report, which reinforced the view that the Fed may accelerate its timeline for rate hikes. Although only 199,000 jobs were created in December, less than half of the market forecast, the jobless rate fell to 3.9% and hourly wages jumped 4.7% from a year ago. The Dow Jones was little changed today, falling about 0.3% earlier in the session as gains in bank stocks amid expectations of higher yields were offset by tech losses. The small cap Russell 2000, it declined 1.2%. Meanwhile, the S&P 500, it slipped 0.4% and the tech heavy Nasdaq dropped about 1% to book its worst week since February of 2021, down more than 4% as money continued to flow away from growth stocks and into value stocks as the 10-year yield hit 1.8% intraday. The growth and value divide is real, and it was represented the most by the Russell 3000 Growth Index falling 1.1% today, while the Russell 3000 Value Index actually rose 0.2%. We saw this exact same divide yesterday. It's only getting bigger. And this is the whole reason why we put together our value stocks list. So you know what companies to look towards. If anything, our top 10 list can guide you in looking in the right direction. So remember to check out our top 10 list by clicking the first link in the description or the link in the live chat. Among single stocks, chip makers such as Nvidia and microchips, they lost somewhere between 3 and 4%. Also, Tesla, it erased 3.5%, and Netflix lost 2%. Still, on the week, the S&P 500 traded 1.7% lower, and the Dow Jones slipped 0.1%. From a sector perspective, the S&P 500 information technology down 1%, consumer discretionary down 1.7%. Those sectors underperformed in negative territory. Conversely, the energy sector, which I've talked about, I believe, every day so far this week, this new year, on our new yearly or daily live streams for this year, energy outperformed up 1.5%. That was the best performing sector in 2021, and I believe will be the best performing sector in 2022. Also, financials, they were up 1.2% as well. Those were the sectors gaining more than 1%. Extended their weekly gains to more than 10% for energy. Just think, energy. That sector is up 10% for the week. And financials, they are up 5% for the week. For what it's worth, the S&P 500 closed just above its 50-day moving average at 4675, which is a key technical level that has attracted buy the dip efforts in the past. If we hop over and look at TradingView, and specifically the S&P 500, I will pull that up right now. SPX is the ticker symbol that I use for the S&P 500. And as I zoom in here on today, you will see that the candle wick, it did dip below the 50-day moving average, which is the blue line. However, it did close above it. Just like yesterday. Yesterday, the candle wick actually fell to the 50-day moving average and bounced off of the 50-day moving average. So are we in a scenario, a situation, where when we open on Monday, could we close below the 50-day moving average, putting the S&P 500 in a bearish structure? It's a possibility. If we go back here, and we don't have to go too far back, December the 17th, we closed above the 50-day moving average. The candle wick actually just barely dipped below it. Then the following session on December 20th, we closed below the 50-day moving average. But it didn't last. It was like a rubber band being pulled back. And the very next session on December 21st, we popped and closed way above the 50-day moving average. And if we go back and look here on December the 1st, we closed below the 50-day moving average. Very next session on December 2nd, rubber band, boom, back above the 50-day moving average. And we seesawed for 2 sessions, closing below it on the 3rd and then back above it on the 6th. Is this the type of action we're about to see? A seesawing or rubber band effect around the 50-day moving average when we open on Monday and then finally close the day out on Monday. It's interesting to see, because if we take the whole year of 2021 plus the first week of trading in 2022, the 50-day moving average always acted as support. Whenever it got down to that 50-day moving average, it would bounce right off of it. People would come in, buy the dip. Has the dip mentality worn out? Is it over? Could we say that potentially we had a not very defined, but nevertheless, there was a slight dip here in the middle on December the 31st, a double top, and now we are reversing lower. Could we be in correction territory this time next week? It's very possible. That's why it's very important to know where we put our money. It's very important to identify the sectors and then the stocks, or if you want to stay with an ETF, where is the best place to put our money during a correction? Well, again, I don't want to continue just saying it over and over and over, but that's why we put together our top 10 stocks lists for value, growth, dividend, and momentum. And they are constantly updated, so you always have the best information. Let's look at Bitcoin. It's down 2.6% the last time I checked today. BTC USD, and I use Coinbase data on TradingView. It is down 3.2% now. So it's fallen a little bit more. Now, I do not have the volume candles on here, so it's a little easier to see. But this fall, look at this black line here. This is a trend line. Now, the candle wick for the day did dip below it, and it got as low as 571, but it bounced back up and now it's at 41,674 and now it's down 3.2%. So it's really moving around. Can it close above this trend line? Can it stay above this trend line? For me, the most important thing right now when it comes to Bitcoin is down here a little further. A little further. And as a matter of fact, I'm going to put a line to mark this. And that line is right at $40,000. A little wobbly. $40,000. Could that be a bottom for Bitcoin? What do you think? I think $40,000 is going to be very critical for Bitcoin. Not only if it does fall below 40,000, it has broken below this trend line, and this bottom trend line has held up in the past on big downward momentum. As I scroll in here, the last time we hit this bottom trend line was the 21st of July of last year, and it held. That trend line also held over here, October 14th of 2020. If we break below this trend line, $40,000 is going to be a very important number. If we look at where $40,000 has affected price action before on Bitcoin, we only have to look back to September, where we had this double bottom effect right here, where it came down to 40,000 and it actually got as low as 39,600. And people were freaking out then. And we were talking 39,000 to 40,000 being a important area to watch. And I'll say the same thing here. 40,000 solid. Give it a little wiggle room, dropping down to 39,000. So 39,000 to 40,000. A little wiggle room. If it goes lower than that, then I think get ready for a crypto winter. Not winner, INNER. Winter with a T. Because then we'll have a tough time in crypto in Bitcoin until the next halving event. So just some thoughts there to share on the technical structure here of Bitcoin. I know it's the Wild West. This is a very new asset. And there are people who have very strong beliefs in cryptocurrency. I do believe long term in the technology. The price action, on the other hand, is up in the air. Really? Does anybody know? Does anybody have a real good understanding of what may or may not happen next? I haven't been able to find it in my research. I've listened to a lot of great people, very smart people talk about it, but even them, some of their predictions just didn't pan out. A lot of people, one of the ones that was the most accurate leading up till November, that was the stock to flow by Plan B on Twitter. His stock to flow model, it was accurate for 3 months in a row. And it has obviously fallen through here recently. Now, it's just a model. No model is perfect. I understand that. but it's interesting to say the least. But I think this 39 to $40,000 level is going to be critical because if it breaks below that, then I think it's a real good possibility that too many will be in a negative mindset and it will lead into a crypto winter. Let's look at Ethereum because Ethereum is actually performing worse today than Bitcoin. ETH on TradingView. Now, Ethereum is down 6.4%. Before I went live, it was down 5.5%. So it's dropped almost a whole nother percent. Now, for Ethereum here, it's not down to its most lowest trend line, but here we are. The wick of today's candle almost came down to this trend line. And its low today was $3,065. It's at 3,187 right now. And I know just a few days ago, we were talking about the 200-day moving average. And it has just fallen right through. Today was a big one for Ethereum. But I still think Ethereum does have a catalyst this year, in the first half of this year, with the update going through. So fundamentally, there's at least something happening for Ethereum to grab a hold of that Bitcoin doesn't. All right, let's talk about a couple stocks that I want to dive deep into here. First up, I do want to talk about Gamestop. Now, I know I don't talk a lot about it. GME is the ticker symbol. Now, I know I don't talk a lot about GameStop. It's been in this range all year long, and it's got this bottom here at somewhere around 140 with a top around 225. Hey, Devin, got my wife investing a bit. That's awesome. She's looking for good for the soul stocks. What's your favorite benevolent pick? Good for the soul. Good for the soul. I might have to think on that one for just a moment. Good for the soul. Um, one that I do talk about, or I have talked about in the past, BBWY, Bath and Body Works. I've talked about this one in the past. I like it, except it's going through a what a lot of stocks are going through right now in the macro environment. It is just putting a hurt on it. But it's been one that has followed the S&P 500, and it's a solid company with a good fundamental foundation. LOL, I couldn't think of many either. It's funny how little I consider it. Yeah. Um, it is. I do try to, not very often, obviously, but I do try to think of stocks that are more for the opposite sex there. And that's why I've talked about Bath and Body Works, Bed Bath and Beyond, even Victoria's Secrets, just to not be completely closed-minded to another's perspective. Um, but Victoria's Secret, that used to be a part of Bath and Body Works until they spun it out. But Bath and Body Works is one that I think is worth looking into. Um, since they spun out Victoria's Secret, it's been a much healthier company. But it's going through there's nothing that's happening with the company right now that is negative. It is just the overall market. Another one is Ulta Beauty, ULTA is the ticker symbol. It's another one. It's a little choppier than Bed Bath and Beyond. I'm sorry, Bath and Body Works. But it tends to have the same trend in moving, but it is a little choppier. But it's another company, solid foundation, uh, good company. Let's see what else might come to mind. Um, Boy, oh boy. Wow, that I'm actually pretty stumped. Besides those two that I mentioned, Bath and Body Works and Ulta Beauty, those are two companies that I think are solid. I would pick Bath and Body Works over Ulta Beauty if I had to flip a coin on the two. Um, who else might come to mind? I'll think about it. She's saying SRI. Yeah. The thing is, look at the I'll let her know. Thanks. I'll think about it and I'll send you a message later this evening. I know there's more out there. I just off the top of my head, those are the only two that I could think of. Um, See the if you're looking at the chart pattern here on Stone Ridge, is this it an auto parts company? Did I pick the right one? SRI. SRI. Stone Ridge. Socially responsible investing. She's found it online after 18 months of investing. I've never heard of it. Again, says a lot. LL. Yeah, ESG investing is definitely something that is becoming more mainstream. I know a lot of bigger hedge funds, they are using ESG to guide where they invest their money. And ESG, it I believe that was one big component to why Tesla was accepting Bitcoin just as a real quick. Oh yeah, Elon Musk said let's take Bitcoin, so we need to take Bitcoin. But then his ESG department got involved and said, Bitcoin's mining isn't as clean, so you should probably back away from that. So I think his ESG department is really what made the decision for Elon Musk to come out and talk about the way crypto is mined and it's not using renewable energy. So I actually did a blog post about ESG over a year ago. Um, as a matter of fact, I wonder if I don't think I listed any stocks particular. Uh, Let me go check real quick. But yeah, it is definitely an investing strategy or investing theme that's out there. I know there's ETFs too that follow. Let's see here. It's loading. All right. Socially responsible investing, fast growing strategy. Let me see if I put any here. I'll pull this over too. I don't know if I mentioned any companies in here or not. Uh, so the tagline I have for it, investments in financial enterprise can change the world in many different ways. Knowing where your investments are going can help change the world and for the better, especially if you are taking socially responsible investing as a choice or path on your investor's journey. Read on to discover what socially responsible investing or SRI is and how this style of investing can change the world for the good. So, yeah, I wrote this a while ago. I've got an ETF on here, iShares MSCI KLD 400. GSI, let me look at that. GSI. All right. So it really moves. This one's really moved in a very lockstep pattern to the S&P 500. Let's see. Did I mention something about it? Let's see. So it tracks an index of companies that have, quote, positive environmental, social, and governance characteristics. That's the ESG, environmental, social, and governance. The fund is well diversified, boasting more than 400 holdings, investing mostly in large and mid cap companies. Some of DSI's, that's the ticker symbol. Biggest holdings are Microsoft, Facebook, Alphabet, and Procter and Gamble. All of these companies have multiple women on their respective boards. Uh, the shortened formed SRI. All right. So I wonder if I gave any other ones. I put Sunrun in here. Ticker SHE, SRI. It's a gender diversity ETF. SHE. Stonehorse Energy Limited? No, that's not right. Spider Series Trust, Spider SSGA Gender Diversity Index EFT. And it's tracked pretty close to the S&P 500 too. So that's a couple ETFs that are part of this. I wonder if I included anything else. In this one, the gender diversity ETF, the fund's top 10 holdings are Visa, Home Depot, Johnson& Johnson, PayPal, Wells Fargo, Texas Instrument, Walt Disney, Netflix, Coca-Cola. All these companies have multiple women on their respective boards. Okay. Yeah, I wrote this thing like well over a year ago. Like I think before I was really doing YouTube videos because I started blogging first before I started really doing YouTube videos. And it just led me down the path to doing videos instead of blogging. Okay. Well, that's a couple ETFs there. If you want to, I'll link this in the live chat here in case she wants to read through it. There you go. Yeah, okay. So, yeah, that should be helpful. Excellent, thank you. You are welcome, Devin. And I'll look a little more into it tonight. Maybe I can find some more specific companies uh, that might work. Cool. Okay, let's see here. Where did I leave off on my notes? I wonder if I wonder if I had I think I did another blog post. I'm just looking real quick. I'm not sure. I can't remember if I did another blog post on it or not, but I want to. No, I guess that was it. Well, it's been a while since I've looked through here. Um, no, no, not that many. All right, so I guess that's the only one that I did write about. But I'll look a little deeper and see if I can't find some companies that might fit the bill for those. I believe even, if I'm not mistaken, isn't Kathy Wood coming out with an ETF, her clean ETF? I don't know if that's uh, ESG or not, or socially responsible. I'll have to look. I'll look into it a little bit further and see what else I can't find. All right, GameStop. So I don't normally talk about GameStop, but there is some interesting going ons at GameStop. So it's been range bound. It's at the bottom of its range for the past year. Right now, it was up 7.3% today. It's down almost a half percent in after hours, but yeah, it's right at the bottom of its range. But the reason I'm talking about it is they had a bit of an update. So the I guess the only really way to describe GameStop is the wild ride that is GameStop. Its stock is in full swing today, being up 7.3%. And it followed by a report from the Wall Street Journal that highlighted the company's cryptocurrency and ETFs, and ETF is non-fungible token, their aspirations. The knee-jerk reaction, it catapulted shares higher today. And back in the very beginning, I mean, it catapulted them many, 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 many percent. But after yesterday's close, they have been in a downtrend. But a large portion of these gains and wipeouts, there may be some good news for the fundamentals of GameStop. So just remember that sudden moves in GameStop are not uncommon. And I know a lot of people assign meme stocks to them, but I really prefer to call them momentum stocks. And usually they have very, very high short interest applied to them. Right now, GameStop short interest is about 13% of their total float. Undoubtedly, short coverings that played a significant role in the initial burst higher for the stock. However, there is also some potential fundamental value in GameStop right now. Determining that value, however, from a financial standpoint is very difficult. It's a very difficult task given the volatile nature of cryptocurrencies. I mean, Bitcoin is down nearly 40% from its highs, and the infancy of NFTs. With that in mind, here are a few overarching takeaways from this accelerating evolution for GameStop. To avoid becoming another blockbuster video, as physical game discs fade away, everything is going digital. GameStop must align itself with where the gaming industry is heading. There is virtually no doubt that digital downloads of games and in game purchasing of virtual items will continue to rise. Therefore, digital currencies and NFTs, which use blockchain technology to record ownership of virtual items, seem to be a natural fit for the gaming industry. Over the past year, GameStop has dramatically shaken up its leadership team as it implements this major digital transformation. Ryan Cohen, co-founder of Chewy, ticker symbol CHWY, the leading online pet food and supply company, became chairman of the board, while two others came over from Amazon, ticker symbol AMZN, to fill the CEO and the CFO roles. In my view, the changes at the top significantly improve GameStop's odds of successfully executing this turnaround. The executives wasted little time in carrying out the new strategy, with GameStop aggressively hiring new NFT and Ethereum specialists to help build a Web 3.0 gaming unit. Now they have that in house. In fact, the Wall Street Journal article doesn't come out as a surprise because reports did surface in October that GameStop was looking to fill these roles permanently. Furthermore, during the Q3 earnings call on December 8th, Matt Furlong, the company's new CEO who came from Amazon, stated that the company is indeed exploring opportunities in blockchain, NFTs, and Web 3.0 gaming, which Web 3.0 is the metaverse. One certainty is that it's going to take time for this transition to unfold for GameStop and its financial results. It'll also take time for those to improve. The Q3 earnings report, which featured a much worse than expected loss per share of $1.39, offered a stark reminder of how difficult and turbulent this transition will be. By not offering financial guidance and not fielding questions during the earnings call, this point was really hammered home. That unpredictability won't improve with increased exposure to cryptocurrencies and NFTs, creating a different kind of risk for GameStop and its investors. In my view, GameStop's vision to develop a crypto and NFT division is a compelling story, and it offers the company an opportunity to reinvent itself. And a lot of companies aren't even given that chance when they are failing. However, though, this story is still fraught with high risks from both the trading and fundamental perspective. At this stage in the game, I believe it's wise for most investors to take a wait and see approach. Now, I know diamond hand GME holders won't appreciate that much, but I always try to be honest, especially as the market continues to punish more speculative assets. Remember the growth and value divide. It's getting worse day by day. So, again, just reiterating, even though GameStop has these fantastical ideas and they're putting the right people in place to execute these ideas, it will take time. Therefore, the best way to participate right now is on the sidelines, waiting and watching. Okay, I wanted to talk about this yesterday or maybe the day before, but I wanted to talk about Walgreens, Walgreens Boots Alliance. Ticker symbol is WBA. Now, the stock got beat up yesterday and it regained it all today. I believe it was up 2.6% today. So, in a day when things are red and down, it's nice to see somebody up 2.6%. And I think that's because it took investors a day to realize, oh, wait, things look a little bit better here. So, Walgreens or Walgreens Boots Alliance, ticker symbol WBA, it issued a solid beat and raise Q1 earnings report. Same store retail and pharmacy sales grew nicely in the quarter as foot traffic it improved and prescriptions filled saw a meaningful increase. Also, Walgreens raised its fiscal year 22 earnings guidance, a very bullish sign that its long-term growth strategy first outlined by CEO Rosalind Brewer last quarter is progressing well. And maybe looking into Walgreens as a socially responsible company could be uh, could be one that fits the bill. They do have a female CEO, and a lot of the ESGs, that's something they look for, diversity in the board. And in the corporate world, finding a female CEO is not a mainstream something you find. So that's an interesting. This is a side note there from our conversation earlier. Uh, but real quick, before I continue on with my notes here, Walgreens has been range bound in two areas. First is down here with a bottom around $45, $46, and then a midway area of about 51 to $52. Now, from January to March of 21, it was in the lower range. And then the upper range is about 51, 52 up to about 55, $56. And they weren't in that upper range very long from one earnings to the next. So for 3 months. And then they fell. But they've been in this range now for at least the past 6 months, with the bottom 44, 45, 46, somewhere in there. There was a couple times it dipped below, tiny, tiny one here on in July, and then a bigger one here in the beginning of December. But from that bottom here to this top here, that's been a really nice rally for Walgreens. Now, they came down yesterday 2.8% on their earnings, but they popped 2.6% today. I think people realized that, wait a moment, things were better than they looked. Now, Walgreens shares, that rally there over the past month or so, that's been a 20% gain, which makes Walgreens ripe for profit taking, which may have been what occurred yesterday. Investors were realizing that, well, with everything else selling off, let's go ahead and lock in our profits today. But then they realized, after maybe going through and reading the report or listening to the conference call or reading the transcript of it, that, whoa, things are looking a little bit better here. And that's why we saw the turnaround today up 2.6%. Still, though, some investors may not like Walgreens' move to up its stake in Alliance RX from 55%. They're going up to 100% stake. They want complete ownership and complete management of Alliance RX, especially after Walgreens noted last quarter that Alliance RX would be the primary driver behind an expected 8% decline in US revenues for the year. And I think that is why Walgreens wants control. They want to turn that decline around. Now, Walgreens did note that Alliance RX needs to be restructured. And to me, that those are key words for we're taking over so we can turn this around. And it believes it can, or it believes a restructuring can be accomplished quicker if under one owner. And that's another reason for why they're doing it. Although the stock's price, its price action over the past 2 days is not showing it, Q1 still had its share of highlights. Adjusted EPS beat estimates by over 30 cents, continuing Walgreens' impressive run of beating by double digits for the 5 straight quarters that it's come through. Gross margins, well, that expansion assisted the strong earnings growth in the quarter. Tracking on top, 120 basis points move to 22.4%. The equally solid sales growth also helped drive Walgreens' earnings beat. US retail comps that grew by 10.6%. However, the year ago number worked in Walgreens' favor, as last year's retail comps were up only about 0.4%. So those were really easy comps to beat. Nevertheless, the company or the comps are still up by low double digits on a 2-year basis. Much of the quarter's robust US retail sales, that growth was aided by soaring growth in health and wellness, which leaped 24.7% year over year as consumers flocked to, of course, at home COVID-19 testing kits. I'm curious to see how that will be moving forward. US pharmacy same store sales continued to perform well, jumping 6.8%, building upon a solid 5% growth from the year ago period. Most of this growth came from the administration of the COVID 19 vaccinations. Since flu shots returned to more normalized levels compared to record levels last year, in international sales metrics, comp growth was similar to the US in both retail and pharmacy. However, foot traffic in the quarter was about 20% below pre pandemic levels, setting up Walgreens' international segment to continue growing going forward as traffic continues to improve. Lastly, after Walgreens announced its strategic initiatives in this previous quarter, including a $5.2 billion investment in its primary care offering, Village MD, there was some concern that its earnings growth would come under pressure. Walgreens did ease some of those concerns by guiding for long term earnings growth of 4%, but it still guided fiscal year 22 adjusted EPS growth to be flat. Therefore, raising its fiscal year 22 earnings guidance to low single digit growth is a good sign that its growth strategies are not putting it further strain on earnings growth overall. Walgreens' Q1 results were a solid start to fiscal year 22, and its raise fiscal year 22 earnings guidance is a nice bonus. I think the rough reversal in the stock, down one day big, up another day, at least 2+%. Not very big when you look at other things that move 8 or 10% a week, or I mean a day. I think some of it can be attributed to profit taking. I really do. And then a general distaste for Walgreens going all in on Alliance RX, which is expected to drag US revenue growth down by 7 points this year. However, I like Walgreens' long term growth strategy and believe pullbacks in the stock act as solid entry points for buy and hold investors, especially given its 3.6% dividend yield and the valuation of 10.6 times fiscal year 22 earnings. So, this 20% rally this past month, it being now in the upper range band, maybe a pullback. Oh, excuse me, maybe a pullback to under that 5150 line there in the middle. That would be the better entry point. Right down here in this area. And if we move that out, it could get that low. The 50-day moving average right now is 49.08. Hitting that mark, to me, wouldn't be bad. But I do think, though, that it would be better for the stock to rally than to pull back much further than the 5150. Because we've got this 200-day moving average here. And if it pulls back and falls below that 200-day moving average, that really sets it up to be in a very bearish structure. And I don't think what the company's doing deserves to be that way. I think what the company is doing deserves to get it out of this rut of being range bound. I think maybe let it come down to the 51.50 line here one more time, and then see you later. Get back up here, and let's get into a new range. Something above the 56, maybe even the $60 range. Over the past 51 weeks, it's only gotten as high as 57.05. It's got to break out of this range. All right. That's all I had to say for Walgreens. Now I want to bring up a newer company, maybe one that you haven't heard of before, and it's ST Microelectronics. ST Microelectronics. The ticker symbol is STM. And you actually, if you have to make sure that you're clicking on the New York Stock Exchange one, NYSE. Otherwise, you might actually click the Euronext, Euro Exit Paris one. All right. As you can see, the first thing that stands out here on the stock chart is very spotty movement. There's a lot of holes in between candles, meaning it doesn't move much. And when it moves, when it wants to move, it can put some pretty big gaps. As a matter of fact, its last earnings, even though it missed, there was a gap up. It's really healthy right now. It's above the 50-day moving average. That's great. So this is going to be, this is the last one on the list that I want to talk about, but ST Microelectronics. And their move to raise its Q4 revenue guidance by 4.7%, I think is helping it to dodge the continued sell-off amongst other major chip stocks today. If you look, Nvidia was down substantially. This is a Swiss chip component manufacturer, and it expects to cap off fiscal year 21 with $3.56 billion in quarterly revenues, a solid improvement from its previous $3.4 billion forecast, amounting to a 10% year-over-year growth rate. STM, I'll just use their ticker symbol instead of ST Microelectronics. STM, or ST Microelectronics, cited better than anticipated market dynamics as the reason for its higher expected sales. Along with raising its Q4 revenue guidance, STM also indicated that it expects to expand gross margin at or above the high end of its range of 41 to 45%. This would not only represent a tremendous improvement of 640 basis points year over year and 340 basis points quarter over quarter, but would also give STM the highest gross margin it has had seen in 5 years. During its Q3 earnings call, STM briefly touched on the basis for its Q4 gross margin forecast, noting that it continues to operate in a positive price environment while also running all of its plants at full capacity and efficiency. Adding to this, STM also expects margins to remain elevated in fiscal year 22, given its backlog, a better product mix, and further room for productivity gains. However, this enthusiasm was followed up by STM expressing concern that there were still inflationary costs that would progressively materialize in coming quarters, adversely adversely impacting margins to a degree. Still, STM expects gross margins of at least 41% for the year. The inflationary costs are not the only headwind STM is dealing with. In Q3, STM commented on the current constrained global supply chain, noting that it expects a material gap between its manufacturing capacity and the level of demand to persist in fiscal year 22. Now, this is also contributing to a robust backlog. For example, STM noted that its automotive segment, which makes up about a third of total revenues, has a backlog covering about 18 months of demand as of Q3. Bottom line, even as the PHLX Semiconductor Index, ticker SOX, is down about 2.5% today, STM's raised guidance is helping it avoid that broader sell off. One of STM's key I don't know why I get this mixed up. Differentiators is its strategy to target high volume applications with differentiated products, which keeps its inventories lean as the chipmaker focuses on developing custom made components. This helps drive down costs, allowing for the excellent margin expansion. That's a phrase that I love. Margin expansion. Also, while some companies may be stockpiling inventories to keep up with demand, STM's strategy, their lessons, they lessen the risk of too much supply at once. And supply chains at some point in this year returning to normal. Okay, this Sunday I will be putting out a Catalyst Watch video, so make sure you're subscribed for that. Sunday evening, we'll kick off the new year with our first Catalyst Watch video, and we'll be running them all year long. A couple things to help out the channel. Number one, if you found this video to be helpful, informative, actionable, click the like button. The second thing is take the link, the URL, share it wherever you can. And then three, if you are not a member yet, click the first link in the description. Check out the different tiers. The most important thing that I want to give to everyone right now is our top 10 stocks lists. Top 10 value, top 10 growth, top 10 dividend. And we share with you, for the majority of them, how we get to where we are, how we choose those top 10 stocks. Now, the value, the growth, and the dividend, they're constantly updated. They are updated at a bare minimum of once a month. As conditions change in the market, they are updated more frequently. The momentum stocks list, the top 10 momentum stocks, or I like to call momentum plays, that is updated once a week because those companies, momentum stocks, are always changing. So that list is updated every week. This to me is the biggest benefit that I could come up with that I think would really benefit investors. I know for me, I struggle with coming up with, all right, where should I be investing? Should I be going for single stocks? Should I be going for different themes or ETFs? And when I was a new investor years ago, I knew nothing. I had no idea what companies to invest in. I had no idea whether I should be investing in stocks or ETFs. It just, but everything I've learned really is peaking with these lists. To me personally, it's not just, oh, let's use this screener and let's just plug in some things and pop out, oh, here's some 10 stocks. This is what we'll use. No. There's a very specific way we go about coming up with these stocks names, with these different stocks. And sometimes we don't use typical metrics to come up with these different stocks. Like your value stocks, for example. A lot of times when people are coming up with a list of value stocks, they're using PE ratios and dividend yields, etc. But I think they're missing one of, if not the key metric, completely left out. One of them is relative strength. That shows that these stocks are relative to what's happening today. And if the relative strength is low, then it's not on others' radar right now, meaning the stock won't appreciate. The stock won't go up. And another thing for value stocks that is critical, and I mean very important, the stock's price is not going to go up if others aren't purchasing it also. And one of the biggest groups to purchase stocks to make the price action move are institutional investors. If you have a list of value stocks that nobody's investing in, then you're buying them and you're basically going to move sideways, break even, and earn the dividend that may be with it. But if the bigger institutions are buying them too, then you're not only going to be able to gather the dividend that's being paid, but you're also going to be able to get the appreciation of the stock. The price will go up. So it's one of the key factors that I don't think very many people, if none that I have seen, use that metric. So there's a lot of work that goes into those lists. So they're there for you, to help you, to help guide you. So do take advantage of them. Look them over. Use them if you want to, but they're there for you and they mean a lot to me, and that's why they're out there. All right. Well, we'll wrap it up here. We had a lot of fun things to talk about today. And yeah, so that'll be it. Thank you guys for joining me today. Have a great weekend. Watch for the Catalyst Watch video on Sunday evening. It'll be a live stream. And then after that, I'll see you in the next video.